Hi, good afternoon, ladies and gentlemen. Thank you for your time. We are LNG Capital. We are credit veterans, sticking to the liquid part of European long-short credit. The background of the team is Louis Gargor and myself as principal partners, ex-RAB Capital, for those of you who remember RAB. And we spun off in 2006. LNG Capital has gone through a few phases, and then we launched the LNG Europa Credit Fund in April last year. We have managed to gain significant interest as well as an institutional backing in 2011 as a liquid European credit long-short fund. Where are we in the credit cycle? I think we've all seen the hunt and chase for yield by Europeans and the US investors, and specifically after 2008, we've decided, or we've stuck to the guns, that we will provide liquidity in the market. So we do remain extremely focused on that key point, is we can turn the book around within a week, and which we did in July and August last year when vol hit the market. We managed to get the net exposure from plus 60 to minus 40 within like 2 days. And that's long short cash, excluding CDS. We think credit is extremely interesting at the moment. We think default rates will remain low for the rest of the year. We also do think that there's been a huge dislocation between the sovereigns in obviously peripheral Europe and corporates, whereby after 2008 we've seen the corporate balance sheets of corporates within Europe have been restructured. Refinancings have been done, even though people, in 2010, people were saying this huge maturity wall looming up, people cannot refinance, but corporates are in a better shape today than they were in 2007 and 2008. We are beginning to see banks' capital lending to corporates getting very thin, i.e. this year, first quarter of this year, we have seen banks refinancing their bank loans with a lot of bonds in the high yield market. Now, I'm not saying that's good or bad, but I'm saying that on a risk-adjusted return basis, for a lot of good key core names, you are getting an opportunity to enter an asset class which does offer a significant amount of upside, given the current state of the markets. What this has done is it's starting the part of the stress, what I'd call the stressed credit cycle. So as bank capital gets thinner and thinner, and refinancings happen going forward into time, we will see credits which are the fundamentally weaker credits will actually start getting, the access to capital for them will be very, very thin. And this is where we think that our key shorts can apply for fundamentally weak credits going forward. What we've tried to do is we trade through 5 different strategies, and these are the core 5 strategies, and we're very liquid. So the special situations, for example, it's liquid special sits. It's not distressed. It's not 3-year workout situations. It's bonds that trade even in a weak market, 2 million by 2 million, 3 million by 3 million, with a 2 to 5 point bid-offer spread, obviously depending on the market or time of the market. Core long-short high yield is something that on a fundamental basis, the companies that we like and we carry on liking, that gives us a yield. So for the first quarter of this year, when we saw the rush for yield coming, and in December last year, we actually took advantage of the market on companies which we like, which are fundamentally strong, we have bought, and on companies where we think, or corporates which are fundamentally weak, we have shorted into strength. So at any point in time, our net exposure is typically between plus 60 to minus 60, and we are very flexible and extremely nimble. Event-driven, it could be a ratings change, it could be a management change, it could be any specific credit event, which could be either a long or short strategy. Investment grade is key, because we think at times when the market is very toppy, we find extremely cheap shorts within the investment grade space. Also, what we've seen are credit fundamentals for BBB companies which are very weak and cannot maintain their investment grade status. We have managed to put shorts on at 200, 250 basis points over, which as they come into the high yield world or the fallen angels, we have managed to take advantage of that situation. And finally, relative value arbitrage, lack of a better name. It's being, in extreme times of volatility, this is the strategy we use. In 2011, we closed the year up, and we weren't 100% net short, and neither were we 100% net long. What this strategy does is, when we analyze the capital structure of a company, we see where the capital structure is actually mispriced. And on the part of the capital structure which we think has a recovery value or offers value, we will be long that part of the capital structure. And the one where we think the capital structure is actually broken and the leverage to that part of the capital structure actually eats into your enterprise value of the bonds or of the company is where we'll short it. Obviously, we look at the spread per turn and we look at the technicals and the fundamentals before doing that. And I think we should have a slide here. As you can see, the gray part is the relative value part of the strategy. So every time we've seen a dislocation in the markets between either, whether it be the sovereign crisis or even historically the dot-com crisis in 02, I don't think we've got the historical figures here, but in 02, 08, and 2011, we have actually managed to preserve investor capital, as well as in a time of decent market positioning, we managed to give good returns on a risk-adjusted basis to investors. Typically, this is a trade example, we'll come into this in a second. Typically, we look at keeping, in an environment like this, the duration of the book is 2.5 years. So we have very short duration. Our average rating on the book is BB at the moment, as well as the current exposure is 40% net long at the moment. What we have done is we've looked for asymmetric risk-return shorts, whereby in a gappy market, I mean, as money managers, I'm sure everyone's aware of, when there's a huge market rally, your shorts crush your performance and eat into the performance of your longs. So what we've tried to do is be intelligent about it, where we've seen that in a market which gaps in due to technical reasons, we've put on shorts which will exhibit a very low beta. But if there's a situation where the market actually completely craps out, these are the shorts that will hedge your tail risk on the whole book. And that's what we've done successfully in the past, and we carry on doing this. This is a trade example of Repsol. We got involved in it half an hour after the news. Literally looking at, I think people who've been following the news is looking at Repsol as a standalone entity. We played the full curve. The curve flattened the minute the news came out. And we sold the front end of the CDS at 300 basis points. And we played the basis between the 2019 bonds and the 5-year CDS. In 2 days, we realized a profit, and we got out of the position. So we are flexible, we're nimble, and we aim to make money across any kind of given markets. That's all I have to say. Thank you very much.